Welcome to the Stockout. This is your show at FreightWaves for all things related to consumer packaged goods, CPG, and their supply chains, and have a lot to talk about today. The topic of the hour was last week's announcement that Kroger will be acquiring Albertsons in a big deal, really blockbuster deal in the grocery space. I'll talk through how I think that's going to impact the CPG companies, and I'll also talk through a few news stories that appeared on FreightWaves.com that I think that are very relevant to the CPG industry. But first, let's just give a little word from our sponsor, which is RJW Logistics Group. RJW owns and operates every step of the middle mile. As an asset-based integrated logistics company, they offer a full suite of retail supply chain solutions under one roof, including industry-leading retail consolidation that consistently delivers over 98% on time and in full, month after month to many retailers. RJW's programs offer global suppliers control and transparency, helping them improve in-stocks, achieve retailer compliance, grow market share, and increase sales. Visit rjwgroup.com to optimize your supply chain today. So we'll be talking to RJW next week on the show. And today I'll just go through really what I think about the Kroger, Albertsons acquisition. So if you haven't seen it, announced a definitive agreement to acquire Albertsons. It's expected to close in early 2024. So it is going to take, let's say, a year in early 2024. So about a year and a half to 2 years to get it fully approved. In terms of traditional grocers, it's the largest buying the second largest. If you consider big box retailers to be grocery stores, this is going to be the second largest, acquiring the fourth or fifth largest. So I wrote up a blurb about this for the Stockout newsletter that went out on Friday. And so I'll talk through, some of those things. And really kind of the first thing that I think comes to mind for most following the CPG industry is this consolidation of the retail channel in the grocery segment is going to mean something that's not so great for suppliers. And that's really leaning more on those suppliers for, price declines and those things. Just have a harder, driving a harder bargain, sort of using the Porter's 5 forces. I think that's sort of the most obvious thing. And Kroger appeared to confirm that in its analyst call. They said they expect about $1 billion in cost synergies. And they said the biggest buckets of that are negotiating leverage with its vendors. That's the CPG companies primarily, and supply chain improvements, which will be interesting. I mean, Kroger has a little bit more of a centralized supply chain. Albertsons is a little bit more decentralized. And so there could be some consolidation there. They said they are going to go out to their supplier community, the CPG industry, as a unified company. And it seems like they're going to do that kind of right away, not necessarily waiting for the deal to close. And you sort of look at the big CPG companies and sort of their current customer concentration. And most of the big CPGs will say that Walmart is about a 20% customer thereabouts when you look at their SEC filings. And they say that no other retailer is more than 10%. That'll probably change. Will there still start to list, Kroger, Albertsons, whatever the resulting name of the corporate company is going to be in kind of that 10 to 15% range once that deal closes. Some of the other implications here, I think it'll be make things more difficult for the smaller CPGs to break into some of these large channels. I think it'll be less of an adjustment for the big CPG companies that already sell into both Kroger and Albertsons, which is most of the big ones. There are some that maybe sell into one or the other. There's some smaller ones maybe hoping to break into those. I think that maybe the smaller ones, might want to adjust their strategy, more direct to consumer, web-based type things, take more of a premium approach. I mean, it seems like it's going to make things more difficult for the smaller, CPGs, or even using, Amazon. Sort of the last week talked to, Chris Moe about the strategy that CPG companies can use in crafting their Amazon strategy. That may be even more important with this consolidation of the retail grocery channel. Another implication here is Kroger's acquisition of Albertsons is going to lead to an expansion of private label opportunities on the retail side. So Kroger gave some statistics here. Kroger's brand portfolio is about $28 billion in sales. That would make it the ninth largest CPG company, and with the acquisition is going to go to 43 billion, which would make it one of the very largest. That's going to be about 20% of their total sales are represented by private label. And I thought the comment that was really interesting from the analyst call was that even though both of those grocers have about a 20% of their sales come from private label, the brands that they're really good at, sort of the segments that they're really good at, do tend to not have a lot of overlap. So Kroger's good at some things on the private label side, Albertsons good at other things on the private label side. You sort of bring both those capabilities together. It's almost like you're going to have a draft, and the better players are going to be on the field, and some of those private label brands are going to go by the wayside. Others are going to go nationwide. And it seems like that's going to lead to a lot of efficiencies on private label manufacturing. They did say that they're going to have 52 manufacturing plants post deal. And if they consolidate some of that manufacturing, not have duplicative things, like I think both of them have a cheese brand that potentially frees up manufacturing capacity for other types of food products, could lead to more potential food product launches. And so you sort of think, well, that 20% private label, maybe that increases to 25, 30, 35%. At some point as the companies, look to grow their private label brand. So I do think there might be some CPG, companies that are displaced there. I'm not sure what those companies would be right now, but it's definitely something to be mindful of. The next thing here is Kroger, acquisition of Albertson leads to a change in data capabilities. And this one I think was really interesting. I mean, some have talked about the data capabilities as really being maybe the biggest rationale for the acquisition. And sort of after the acquisition, the combined company is going to have data on about 85 million households, which is most households. You think sort of 2 to 3 people in a household. Most of those that buy groceries, at least at traditional grocery stores. And so with data like that, usually it's not a situation where 1 + 1 = 2. It's more like 1 + 1 = 3, 4, or 5, because it fills in the gaps of households that have moved, that have changed commutes to work, that just preferences of different grocery stores going to. All those gaps are sort of filled in. It gives the companies a lot of data and insights into not only what they buy on the food side, but also what they're likely to buy outside of food. I mean, there was a quote from Walmart recently that talked about how their highest margin business now is on the data side of things. And you can imagine that taking place with Kroger too. So, someone buys baby formula at Kroger, that's important information, because you have a pretty good idea of what the types of purchases they're going to be buying the next several years. It makes them a target of specific ads that are right in their wheelhouse for things that they're likely to buy for however many years down the line. So very valuable information. My colleague Jack DeLeo wrote up a Modern Shipper article. I think we have a graphic on that. He talked not only about the data side of things, but also a lot of the delivery implications. And so his perception was not only is that the data going to be more valuable, but this is maybe a defensive strategy when you think of Amazon and Walmart trying to take grocery from someplace that you go to someplace that is delivered. Both of those companies have a lot of capabilities there. And Kroger, talked a lot about that too, moving quicker from the field or farm to table, which would enhance the customer experience because it just leads to a longer shelf life. They're going to do things like combine the fulfillment centers. They're going to have a more centralized operation. Over the last several years, Jack talks about in his article that Kroger has partnered with a company called Ocado that builds grocery fulfillment centers. That stock was up significantly after this news. They also have a partnership with Knapp on automation of distribution centers, and Albertson has worked with some technology companies too. So there may be some consolidation in those data and grocery data suppliers, robotics type suppliers. In the article, Jack talks about how Kroger's worked on robotics. I believe that would be for picking, and also looking into things like drone delivery. So Kroger doesn't want to be left behind by Amazon's continual push to make the customer experience, ever more streamlined. So it does look like, with all those things, that the combined company is going to be more productive than any of the individual companies could be, and that's something that the customer experience should be enhanced. The next topic here, and this is a big one, is Kroger and Albertsons. What are the antitrust issues? And this is kind of the first thing that comes to mind, maybe aside from that first topic where they're going to push harder on their vendors, is the Federal Trade Commission will be looking closely at that. They could potentially stop the deal if they deemed it was anti-competitive. We've seen that in the food space before, and they're going to be looking a lot, not just at the nationwide footprint, which the nationwide footprint of Kroger, Albertsons is going to be about 13% share. It's still going to be less than Walmart at 22, but really what's more important is the market share in a particular region. People tend to buy their groceries within, 15 minutes or so. And there are certain areas where there's not a lot of overlap. Kroger is stronger in the Midwest, Albertsons is stronger in the Northeast. But where there's a lot of overlap is some of these Western cities, Seattle and Denver being, a couple of them, Los Angeles. A lot of overlap also in Texas, both Dallas and Houston. Lots of those places are within a few miles of me, both on the Kroger and the Albertsons side. Albertsons under the Tom Thumb brand. And so, Kroger, not taking them by surprise, they have a team of experts looking into this, and their perception is that the Federal Trade Commission is going to require them to divest between 100 and 350 stores. Of course, there could be a surprise, and maybe the Federal Trade Commission is more against it and needs them to divest 600. Maybe they won't allow it at all. It does come at a time when food prices, I think, are on top of everyone's mind, and they don't want to allow something where it's just going to allow companies to gouge on prices with competitive antitrust behavior. Does bring in the question of what actually is a grocery store. Is the market sort of the traditional retailer, or does that include all of the big box retailers, including Walmart? Costco is very big in grocery, and now Amazon, and even things like Instacart and a lot of these delivery boxes. And Kroger and Albertsons both have their own sort of delivery boxes. Sort of my perception is any store that sells groceries is a grocery store, and the wider, broader sense of the definition is really what should be applied. But it's always difficult to predict, those type of things, and maybe they'll be more strict just with the inflation in food prices here recently, and with the Biden administration looking at all of these different industries to see if there's any anti-competitive behavior. They did require that Kroger last year submit a plan for just what their supply chain is going to look like, how to prevent supply chain issues that would ultimately lead to higher prices. Another topic related to Kroger and Albertsons is sort of what's the implication for shoppers. Kroger says that prices will go down for groceries because of this. Others don't believe it. Bernie Sanders is one of those who does not believe it and thinks this is a complete disaster for shoppers. Well, I think it remains to be seen. I think it could go either way, and I think it's sort of a situation where both of those things are true. I think there are some locations where Kroger and Albertsons fight tooth and nail with Walmart, and that greater scope will be invested in keeping prices low so they don't lose market share to Walmart. I think there are certainly places like that. There are other places where getting your groceries at Walmart really inconvenient. You think of densely populated places in big cities. Think about when I used to live in Lincoln Park neighborhood of Chicago. Would have been awfully inconvenient to go shopping at a Walmart for groceries. I think in those cases, they're going to price to the market, and it could actually lead to higher, grocery prices. So it could be a little bit of both. Kroger does say they're going to be investing about $500 million to lower prices. They also say the shopper is going to see improvements to the customer experience. So they're going to be investing $1.3 billion in that. I mean, they didn't give any detail on that, but that could be things like, easier access to, e-commerce, better picking, those type of things. some have suggested there's going to be fewer stores, and some say, well, there's going to be fewer stores anyway because more people are buying their groceries online, so fewer grocery stores are needed. Which seems like an interesting comment that could be right on, and potentially also could this help grocers or consumers because this grocery chain will be in business against Walmart and Amazon. Those two companies won't put them out of business. There'll be sort of this other alternative. I think my sense is that they would have persisted anyway, would just have to carve out a different niche in terms of price point, convenience, those type of things. But lots of interesting things in that space, and it'll be interesting to see how this all develops. I think on balance, it's probably a negative for CPG companies, but there might be an opportunity for some CPGs that sell into one chain to sell into the other. There may be an opportunity for CPGs to leverage this newfound built out source of customer data to market their products more effectively. So there could be some silver linings there. Before I go on to what's happening on freightwaves.com, I would just like to give another shout out to RJW Logistics Group for sponsoring this show. Are you assessing the advantages of prepaid versus collect freight management for delivery into retail? RJW's retail consolidation program consistently achieves over 98% on time and in full to ensure a stronger shelf presence, increased in-stocks, retailer compliance, and overall retail supply chain improvement. Visit rjwgroup.com to speak with a retail logistics expert about the advantages of RJW's program and to make the best decisions for your business. So sort of right on point with that, with that ad, lots of things to consider for CPG companies selling into retail. I'm going to move on to news topic number one. I did talk about this last week. The low water conditions that are threatening barge traffic, they're still low. And Rachel Premack, my colleague on the editorial side, just put out an article there. There it is. You can see on the screen. Latest supply chain crisis could threaten global stash of food, energy. These are low water conditions. So barges move about 5 miles an hour up and down the river system, but they move at that speed by carrying lots of commodities. About 60% of grain, 54% of soybeans are exported via barge. What's not exported via barge, mostly exported via rail. But there's been all kinds of service issues, and service issues are expected this fall. Surface Transportation Board is really watching the railroad service levels and is skeptical that they're going to be able to, meet their requirements. And so this really doesn't come at a great time for the transportation network to have low water conditions. And these commodities are very expensive right now because of the war in Ukraine. So it's a time when more of the commodities would move. Those high prices encourage movement of these type of commodities. Water levels are lowest they've been in over a decade, and in some cases it's closer to 3 decades. I have a chart on the Illinois River barge freight rates from the U.S. Department of Agriculture, and you can just see how much higher they are. So they're up 319% year over year, and that's up 286% over the 3-year average. And you just see how quickly this has changed. And barge freight rates, I used to cover American Commercial Lines when it was public, and I was a stock analyst. They mostly move grain on the spot market, and those spot rates can really shoot up this time of year. And you can see from this chart how much they've shot up, where as recently as late August, early September, they were right in line with the 3-year average, and now they're 300% above the 3-year average. And that is to say nothing of how difficult it is to get the service levels that are required. At one point last week, there were over 100 towboats and 2,000 barges. So let's call it 20 barges in a tow waiting in the lower Mississippi. They've since opened it up to one-way traffic, but that still reduces the throughput of those barges. What the other thing they do is they reduce the size of the tows. When the water conditions are low like this, so the tow sizes have been going from 40 barges to 25 barges. So all those things are making it very difficult to get grain, exported. So hopefully that improves itself. I'll move on to the next, news item here is that CPG price hikes to slow, and that was a a news item I saw from Winsight Grocery Business. I'm on their newsletter. It was one of the many newsletters that I sign up for, and I thought this was interesting because last, let's call it 2 years, CPG companies have raised their prices pretty continually. But they have a survey out now that says less than 40% of product makers, CPG companies, say they'll increase their prices in the first 6 months of 2023, and 1/4 say they have no planned additional price increases going forward. So that seems like it suggests that the CPG companies are starting to see the ingredient costs tail off. Either that, or they think the market can bear no more price increases, or maybe it means that they brought forward, next year's price increases now because there was a perception among many CPG companies that as soon as the ingredient costs start to come down, that the retailers are no longer going to accept any further prices increases. They're going to say we're taking no more. And so there was kind of this rush for CPG companies to increase prices. So even though a lot of CPG products right now, they're about 15% higher than they were a year ago, kind of good news for consumers that maybe they're backing off of that a little bit. Of course, those plans can change, and it's going to be dependent on things like commodity costs, packaging costs, energy costs, transportation costs. But I think on balance, they're starting to see some of those things subside when you look at the latest kind of consumer price data. And I'll talk a little bit more about this in a second. Some of those things have backed off, and really it's been the food prices that have not yet backed off. This news item number 2, and this is going to be the last one I have for today, is grocery prices show further increases. So even though I just talked about how the CPG companies don't have any further price increases planned, when you just look at the most recent month, which was September, still seeing plenty of inflation there. CPI food index rose 0.8% month over month just from August, and 0.7% month over month for food at home prices, which is going to be the one that's more relevant for CPG companies. If you look in the past 12 months, food at home prices have risen about 13%, I believe, for most CPG companies, at least the publicly traded ones that talk about their prices. It's even a little bit higher than that. It's more like 15%. And some of the areas that have risen the most would be things like eggs and butter. I believe those are up 25% or more in those categories. So that's something that need to keep in mind is consumers are still struggling, facing these higher food prices. Maybe they get a little bit of a break going forward, and we're seeing the consumer inflation data start to back off a little bit, but still lots of pressure there. In the last couple minutes here, just would encourage anyone, if you're not signed up for it already, to sign up for my newsletter. Try to get that out twice a week. There it is, www.freightwaves.com/the Stockout. So it's the first one listed there. You go up in the newsletters under supply chains. Talk about a lot of the publicly traded CPG companies. Also, just a lot of trends that I think are interesting. Sort of coming at from the perspective of if I was at a CPG company, what would I want to know? Try to leverage in some of the things like I was talking about earlier with the FreightWaves news articles, as well as the FreightWaves data, which right now the FreightWaves data is showing kind of a lack of a fall peak season. Just heard Donnie Gilbert this morning talking about how tender rejections are sort of trending down in the 4.5% range, and sort of really haven't seen those pick up, or even seen tender volume, which is the volume of requests to move loads, really have not seen that pick up seasonally either. On the rail intermodal side, it's unusual that the rail intermodal spot rates, which is one thing that we see in Sonar, that those have not picked up, that those have stayed low, even though seasonally you'd expect those to surge. It suggests, to me, that the rails are not concerned about securing capacity for their contracted shippers. So that's a little bit of what's going on there. Of course, ocean volume, those volumes have been down. They were down double digits in September, both year over year and month over month. So that was kind of the first month or two that the ocean import volumes have really started to to crack. So lots of evidence that transportation capacity is loosening, which is good news for CPG companies as they wrestle with all their other issues, such as rising input costs. Labor availability is still a real big constraint for a lot of CPG companies, and would encourage you to follow that on my newsletter, and also check out some of the other newsletters, like the retail point of sale is very relevant. The one that Rachel Premax writes, Modes, is relevant if you're interested in equipment. You can check out Alan Adler's newsletter. But with that, wish everyone a good start to the work week.